Welcome, welcome, welcome. Let me just go ahead and, Jason's quick on the draw here. This is the REI Rocks Review. REI stands for Real Estate Investing, in case you didn't catch that. I'm very excited to be doing our last episode of 2022, our very first year. First of all, Angel, how are you doing today?
I'm doing all right. Excited. We finished out the year with this going pretty strong, and I'm excited to start the next year out getting these REI Rocks reviews every Friday and just showing people what we have to offer in our summits each and every time we do them twice a year.
Beautiful, beautiful. It's really, really exciting just being able to go through this content, especially because we go through it at 1.5 times speed. That's helpful. I always read, or I say read because of the captions, but I watch my videos at 2 times speed. And I like that we do the 1.5 times speed on this show because it keeps me from falling asleep, which is important. But the bigger thing is it takes the pressure off of us. That's what I really like because, even if we've got a headache and see Angel's putting on a bright face for you guys, but you should really give her a big, oh, because she's got a headache today. And, she's just too polite to tell you. But Angel, we're reviewing Dan Hanford's presentation today. Do you want to say a few words about that?
Yeah, I absolutely will. So Dan presented this, I guess, a couple years back, but it's so valuable even today because it's talking about the investor relations and capital raising and like keeping investors warm so that you're not only calling them when you need money. So it's a really relationship driven and based model, and I'm just excited to share it.
I love it. I love it. And just to get for anybody in the audience who's brand new to commercial real estate or real estate in general, maybe they've got no experience in this at all. Let's get what the capital raising part is all about. And I think the easiest way to do that is to ask the audience, what would you do if you suddenly got the idea in your head? You're walking up to an apartment complex that you see all the time, but this time you're looking at it differently and saying, you know what, I'd like a piece of that building. It seems like it's absolutely impossible, but where's the first place you'd look? And the answer is it's people in your network, and you'd end up pooling capital together to make that happen. So what's different between what I just described and capital raising to your ears, Angel or Jason?
Jason, you want to go first or me to go? Okay. So in the beginning, I think many of us are led to believe that if the deal is great, the money is just gonna happen. We've done a couple of deals now, and let me just say the money doesn't happen. You work for every dollar of it, and that's okay. It gives you a real tie to the property, and that is the skin that you're putting in the game, not just your own funds to sit on the LP side too, but the time that you pour into making the deal happen.
I love that. That's fantastic. So I'm going to hit the share screen now, and I'm going to hit that one right there, and it's this one, and that's the right one, and I'm going to share it. Here we go. Let's do this.
Or to the cloud.
And we're going to pause.
Yay! So now I have a smaller file, which sounds kind of funny, but if you have like a really huge file and you're offering recordings to people, you don't want to have a whole day corrupt because that's really hard to get back. But if you have like shorter ones, it's easier if you had to ask for people to send you a recording or something. Hopefully I won't have to do that because I'll remember to start and stop. Maybe somebody else will help me out. So just to kind of give us a little bit about what's going on with me and my husband, Jason, we actually have an app. I did start it back up. He was just asking me, did you ever start it back up? We actually have an app that is in beta testing right now. So if you want to be a beta tester, let us know. You can send me an email and say, hey, I want to help you beta test your app. It is an awesome, awesome, awesome app. And we've actually got a commercial for it that we'll show in a little bit, but it's basically a connector. And we need people to try it out and see how amazing it is. It's lorecap.app. And I'm sure he'll get that link up there for you. But without going on further, I'm going to go ahead and ask Dan to please start his video. So he'll pop up. Hey.
I'm here. Thank you, Angel.
Yay. How are you doing today?
I'm doing very well. How about you?
I'm doing pretty well. Remember to say well, so good. Yeah, it's kind of wild as you get, as you lead up to something like this, but then you get on it and it's, this is my happy spot.
I know that feeling very well. It's a good feeling to have.
Yeah, it's my happy spot. So for those of you that don't know Dan, most people know, he is one of the managing partners with PassiveInvesting.com, and that looks like your hat too.
Yeah.
And it is a company. It's a national company for passive investors in apartments, multifamily, and he's been doing that for a while. It's they've got over 2,200 units. I want to make sure I get the numbers right. And it's valued at over, what was it, $274 million? Holy night, that is awesome. He's also a passive investor himself, so he's passive in over 4,800 doors. And before he started investing in real estate, he was already really successful at creating multiple businesses. And we're talking like big businesses, 7 figures, pretty massive. He had a large group of, or do you still have the medical clinics?
I do.
Okay. So medical clinics, a big chain of the non-surgical orthopedic medical clinics. And then let's see, I don't want to miss anything. And we all know about Multifamily Investor Nation, right?
Yep.
Which is amazing. It's actually kind of my guideline when it comes to putting on summits.
Good.
So I may copy you a lot, but I mean it in the most, in the best of ways. I'm copying because
No problem. I know we had many conversations. That's not a problem.
You also do the meetups where like people ask you if they can lead them. And so that's how we get more and more across the nation, where it's always the first Monday of the month, right?
It's the first Monday of every month, and it is now we have 53 meetup groups across the country. COVID has kind of put a little bit of a damper on those meetups in person, so we've had several of our meetup groups being done virtually, and we have some of them in Canada. We actually just got our first one that'll be starting soon, hopefully in the UK. So we have we're now kind of international, if you will.
That is awesome, and it's kind of it's actually very similar to what's on my heart, and that's offering that free education, the free real estate investing education, because people and guys, this is an amazing vehicle for protecting your wealth, maintaining your wealth, growing your wealth. It's just awesome. It's in my heart and in my mind, I believe it is probably one of, if not the most recession resistant wealth vehicle out there. So it may not be. And if someone finds that I'm wrong, you can put it in the chat and say, Angel, you're wrong. But it's something I'm very comfortable with now. And I grew up with a family in real estate.
And you said that a couple of years ago, and I'd still say the same thing. If you disagree, please do put it in the chat.
Well, I was just thinking of something too. So like when he started out talking, he said he had, or I think I said it, 274 million in assets under management. He popped $1 billion last year, but then sold some assets. He's over $1 billion again. So this is like 2 years old.
Yeah.
It's when you start scaling this stuff, man, it moves fast.
Yeah. So and Jason has a PhD in chemical engineering, and like that's something that's in demand. It's highly technical, highly specified, something like that. What are the chances in some sort of field of study like that of going from 274 million to over $1 billion in 2 years? Like how likely is that, Jason?
Well, first off, I wouldn't say a PhD in chemical engineering is
It doesn't give you statistical awareness.
highly sought after or anything. So, but the chances if I stuck with my engineering would be 0.
Yeah, that's kind of my take, and that's the thing that just keeps on going through my head. Is so many people, they live, with this mistaken impression that you can choose whatever career you want and still be fantastically successful.
But I know three operators that have hit the $1 billion mark in the past 3 years. And right. 2 of them I know really well. One of them I knew before he got married to his wife, and I knew like his first deal. I knew who 1031 into his first deal. Like, so I know him fairly well, all of them. But that's 3 people in commercial multifamily that broke that $1 billion assets under management mark within the last 3 years, last 2 years maybe. And so that just shows me that there are people around me that are doing amazing things, and you are the 5 people that are closest to you. And so if I can have people like that in my circle, then I believe that we will be able to meet that mark as well.
Mm-hmm, mm-hmm. And it really shows the time value of money, really. And you have to be in an industry where you can actually pull that off. You have to be able to get that time value of money, and real estate is how you pull that off. So that's why it's not a big surprise. Sure, if you end up coming up with some new form of like polymer or plastic or something like that, maybe you'd be able to hit those sorts of
Only if you
numbers.
did it independently, because if you did it within a company, the company owns it.
Oh yeah, exactly. It's just like pharmaceuticals. It's, and universities. It's like, the institution that has all the money is the one that is able to really make those exponential growth sort of moves. And it's really something.
Absolutely.
So my husband grew up with a family in real estate, and so it's something that we know. So, but I'll step off my soapbox.
It's hard to argue, especially when you look at the current environment with COVID-19. I mean, there's been a lot of other asset classes that would have been considered potentially recession resilient that have not performed very well during the last recession. Even some of the asset classes within multifamily have seen some negative effects to it. Mostly like the lower end C-class properties that have seen some of the residents that have just been unable to make their rent payments. It hasn't really had a major impact overall in multifamily. It's actually done fairly well, especially if you look at the National Multifamily Housing rent collection tracker and things like that on a monthly basis.
Yeah. So
I think it's time to do a history lesson, though. Do you want to give basically what's your summary of what happened in 2021 and 2022 in multifamily?
So multifamily has still been fairly recession resistant. I think what we've really seen is a situation where in past recessions, you've seen some layoffs in those high mid-level management positions. So a lot of your people would be looking for Class A residences. And then we saw the service industry this time getting hit really hard because COVID shut things down. And so the people weren't able to really work at all because they weren't considered, some people weren't considered essential. And so the people had a really hard time keeping up with what they needed to keep up with. So when he's talking here about your lower class C, most of the people that are in apartments, low B and in C's, they're like $500 away from not being able to pay rent. Or in some cases, it's even $200. So if a larger bill comes at them, they're not going to be able to pay rent. And I think this is where it really comes into importance of being an empathetic owner and being an investor with heart, because sometimes you have to be willing to do payment plans to keep your residents in place and keep everything moving smoothly.
Mm-hmm. Mm-hmm. Great. So to summarize that and add a little, for the last couple of years, if you're in most industries, it hasn't been very good, unless you're somewhere near the top. But right around the time of this recording, a few months before, I believe, the Fed ended up taking away the reserve requirements for banks if they wanted to make a loan. So what that meant is that back, before COVID, if a bank wanted to write a check for $100, all they'd need is $10 in hand. They put it with the Fed, and then suddenly magically they create this $100 and are able to collect interest on this funny money. But when you remove the reserve requirement, that means they don't have to have the $10. They just have to be able to make the payments. So there's been all sorts of money dumped into the system. And what happened was the people who have all sorts of financial backing, they don't want to just own anything. If you can own anything you want, like, why would you want responsibility? You're only going to be willing to offer responsibility if it's actually making you money. And so people with that mindset ended up scooping up things that have cash flow, and multifamily is one of them. So values over the last 2 years have gone up big time, and a lot of people have looked like geniuses. And a lot of people think that, now, things are starting to get more in line with reality, as a lot of people would say. And that's my history lesson for the last 2 years, to put what they just said in context. I think that should be probably enough. Let's keep going.
Absolutely. I would imagine that there's some people out there right now that they're worried about how they're going to keep their investors. And I think this is something that you're pretty well versed in, how to keep those investors on the table as you move from a deal to another deal. And, how do you make that happen?
Well, there's really kind of four main areas when you look at investor relations as a whole, right? I'll kind of break down these four real quick just so you kind of have an idea. But we're only going to cover one of them inside of these four. It's kind of four kind of steps, I would say, or four categories. Now, the first step is really kind of the initial step in investor relations is like where to find investors, right? Finding investors, getting them into your fold. And that next step is actually the next level of how to maintain those investors. So once you've actually attracted those investors into your network, what can you do, or what are you doing right now to build a fence around those investors so that the next time you have an offering, it might be 6 months, 9 months, or a year down the road, they haven't forgotten about you, right? You want to always be in the top of their mind throughout that entire period of time where you don't have a project to be able to present to them. And then the third level is also securing capital. So we can find investors and
yeah, Dan is just whipping through these topics like so quickly, and
He covers them again.
yeah, right. And so, but I think it's a good time to give an example, which is like with you, Angel. Like how do you stand out? Like obviously having the purple hair, which is natural, by the way. Like that's one thing that sure helps. But like I always like to think of you guys as the down to earth Texas couple, who is just going to keep on humming along, and it's way better to be on the train than off it. That's what seems to stand out about you. Do you have anything else? Because I think there's a lot of pretty generic content out there in this industry, and so with standing out and as part of staying top of mind, do you have any comments about that?
I think the biggest takeaway for me and everything that I've learned over the past couple of years, when we decided to go active side, was just that it's not about spewing real estate deals all over people every time you see them, but building true, actual friendships. I mean, of course, people are going to know what you do because it's going to come out in casual conversation. But I think that it's way more important to build true, actual friendships and relationships, so that you have a good relationship to fall back on when you have a deal. And there's a reason that you're presenting a deal, right? You can go up to somebody and be like, hey, I've got this deal. You are my friend. I want to see my friends benefiting from this deal. Can I show it to you? And I don't think I've ever had anyone say, no, I don't want to see a deal where I'm going to be better. Everybody's been pretty receptive.
Definitely. That's really awesome. And we're at the we're past the quarter after part where we always like to mention where you can get access to all of this stuff. So I cover my face with triangles. And Angel, do you want to say one or two things about the source of all of these REI Rocks reviews content?
Certainly I can. Absolutely. So if you want access to, we actually found more hours. So it's probably closer to like 300 hours of expert content. And you can get access to that for less than $20 a month with our REI Rocks review, or with our subscription to the Academy Presents REI Rocks. And when you get that access, you get to watch it at your own pace, at your own leisure. Now, we do suggest that you watch it a little bit faster. But I do have friends that watch it at one time speed because maybe they're doing other things while they're listening. I'm not the kind of person that can do a bunch of other things and actually get anything out of what I'm listening to. So I kind of have to be focused in, and that's where 1.5 or 2x speed makes a lot of sense because it keeps your brain active and you absolutely have to be there, right? Oh, I just got a chat message asking me a question over here. Yes, all of the REI Rocks reviews are recorded too. So the cool thing about that is that we come into these, we're looking at a past session right now, and we're breaking it down for you. Because just like Dan Fradenburgh said about what Dan HANDFORD said, was that he was like just boom, 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 just sliding and going really fast on those steps. And we're going to stop it, pause it, break it down. And then at the end, we're going to give you the doggy bag of our takeaways. So we're helping you learn how to listen to the content and figure out what pieces are applicable to you. And that information will be in the subscription recordings as well.
Mm-hmm. Beautiful. And you can just scan this QR code here. And yeah, I'm pointing behind myself, and it's kind of funny. And then also, here's the link you can also use. I'd also like to say thanks for all your help on that, Jason. You did a great job. Anyway, let's keep going.
We can maintain the investors, but what are you doing to properly and effectively secure the capital? It's not just sending out an email. That's one of the steps in it. There's multiple steps when it comes to securing capital and doing it effectively and efficiently, because your investors, if you don't walk them through a very specific process, they will get frustrated and they will not invest. And then the last one, which is number 4, is really that post-deal investor management, where how are you handling your investors after they've given you money, after they've invested in the project? What are you doing to maintain that relationship to make sure they feel comfortable in the project that they've invested in, so they can go through that entire cycle once again? And one of the things that one of the areas that we're going to focus on today is really kind of under that, in that second step, right? Is that maintain investors. And before we dive into this, Angel, I'd like to share my whiteboard on the screen here and share with the investors that you have on here a little bit about the investor triad. So I think I can do that here. There we go. That should work. Can you guys see that on the screen? So for those of you who are on, I want you to, on the live section here, I want you to find your little raise hand button and just raise your hand. Let me know that you can actually see this, okay? That way I can make sure it's all looking good. All right, good. All right. So I'm going to do this for you. What I'm going to share with you is something that will...
I should probably satisfy people's curiosity. There's a second video that has the screen part on it. And when I reviewed it real quickly, they ended up making a triangle that was kind of scribbled. And so like, it wasn't like something that was like right up there, and so I think that we can get the picture across just by
well, he's going to talk about it too, and he talks about the different portions of it, because each apex has a different word connected to it, and so he just talks about that a little bit. But yeah, so when you're recording in Zoom, if somebody shares a screen, it's a specific file that has that recording, and well, Streamline gets a little crazy sometimes, and we don't always get all the pieces.
Right.
Kind of help you understand how I see investors, and also how you should, in your own syndication business, if you choose to do that, how you should be maintaining your investors, or really thinking about your investors and how they think. So go ahead and get out a piece of paper for me real quick. And what I want you to do is I want you to write this big, huge triangle on your piece of paper. Now I'm just doing this with my mouse, so I'm not the best artist or anything like that, so forgive me. I want you to write this big, huge triangle on your paper. And in the middle of it, I want you to write the words investor triad. So investor triad, just like this, okay? That's a triad. And then what I want you to do is I want you to write the word know at the top, K-N-O-W, bottom left, write the word like. You've probably seen something similar to this, but I'm going to kind of hopefully expand your thinking a little bit and your mindset about this. So know, like, and trust. So this know, like, and trust is important for you to understand. And these are kind of the 3 things that an investor has to go through in order to really pull out their wallet and invest their hard-earned money into one of your projects, okay? And so for those of you who are on here live, kind of play with me here a little bit, kind of, let me know which one of these 3 things, know, like, and trust, you can do this into your chat box. Which one of those, know, like, and trust, do you feel and do you think is the most important for your investors? Is it know, like, or trust? So just go ahead and type that into your chat box here, and I want to see what everybody is saying here. So I got trust.
I got
trust
this wrong, by the way.
Trust, just about everybody on here.
I'm glad you say that. Yeah. Of course, me as a marketer, I think no is most important. It's just
that's not the one I put down.
Yeah. Okay. Yeah. Well, I can see a lot of people said trust, and I've had this discussion with a few different people, because I'm a little bit contrarian, just because I want to find out what the truth is, so I explore the different options. And I remember saying it's like, I've done business with people I don't particularly trust all sorts of times, and specific and people who I don't like. But I just realized that I'm doing business with more people than most people realize. And I'm talking about restaurant owners. I've had restaurant owners where they are just curmudgeons. I don't want to be anywhere near them, but the food is delicious. So I go there, I stay mum, I order my food, I eat it quietly, I pay my money, and I leave. So now, of course, when you're asking for an investment, it's a bit different. Know, like, and trust, all 3 of them do definitely, become more prevalent. But I don't know. That's just my take, is that you don't always have to like somebody in order to do business with them. You just have to know that they're going to follow through.
I don't know. I'm trying to remember exactly how he said it went together, but I want to say all 3 of them are in play. But there's definitely one more important than the other.
But regards to your restaurant, you go there because you trust that they'll make you good food.
Exactly. So there's a form of trust there, like the places where,
like the,
the hygiene. Yeah, exactly. I definitely like the food.
We're all being contrary,
Exactly.
You're just typing in trust. There's one person that says no, nobody for like. Most of it's just trust, which is what most people would say, is that they would say, trust is the most important piece. And it's not, if you look at this whole thing as a whole, the most important piece of this entire triangle is actually the word no. And the reason why no is the most important is because if you don't do things to get the investors to get,
And of course, it's supposed to be spelt with a K and a W. No.
Yeah.
Exactly. But yeah, no is a fantastic word, especially in commercial syndication, right? Because if the numbers don't work out, you have to say no. But
Absolutely.
it's not on the triangles. So it's cheating.
to the point of being able to know you, then they'll never have an opportunity to make an opinion as to whether or not they actually like you or eventually trust you. And so if you look at this on your drawing on your piece of paper, I want you to draw an arrow from no to like, because that's only the first step in this process. You got to get people to know you first, and then they get that opportunity to be able to make an opinion as to whether or not they like you. And if they like you enough, they're around you enough, then they get to the point of being able to trust you. This piece right here is one of the most important pieces in understanding why you would want to do a 506 Bravo versus a 506 Charlie in a syndication. Because if you don't have a lot of people that know you and a lot of people that like you and trust you, then doing a 506 Charlie might actually not be the best thing. But if you have a following and people, an audience, people know who you are, they know you in the community, in that little network that you're in, then maybe advertising is going to be good for you. You might find a few people that would be able to, put some money in and things like that. But you, with a 506 Bravo, people that already know, like, and trust you, are those are the people that will invest with you the most. And so that's why most people will do those 506 Bravos. Usually about 80 to 90% of all the offerings out there are those 506 Bravos. Now, this isn't a webinar or a topic on whether or not you're going to do a Bravo versus Charlie or anything like that when it comes to the SEC regulations. And I'm not an SEC attorney, but just wanted to mention that there. And one piece to this, know, like, and trust.
The other piece we've heard recently, right, is that, even when you end up doing a 506C, you end up, it's mostly friends anyway, just because you're doing outright competition with all the big boys, right?
Well, so like for us with our teams, whether we did a 506B or a 506C did not change who we talked to. Because with a 506C, you can only have accredited investors. However, what happened was there were people on our team that their investors were predominantly sophisticated versus accredited. And so we went with 506B. I had somebody tell me the other day, you have to have a really great network to be able to do a 506B. And I started thinking more and more about that. But I think it goes back to the relationship driven versus the transactionally driven schools of thought. Because if you're relationship driven, doing a B is going to be way easier all day long than doing a C, because the best thing about the C is that you can blast it out to everybody. But then you're going to be getting investors that they're accredited, but you don't really know them. You don't know their situations. And, I go back to the friend of mine that said she's leaving teaching. She wants to put all of her money with us. And another reason why I can't do that is because, like, she just posted that, one of her family members, one of her children was having an issue. She was going to school states away, and they had to do basically a turn and burn. They drove down early in the morning, helped her get all of her stuff out of her ex-fiance's house, come back here and set her up with a room in her home. And the cost of having to do that and the cost associated with that, I know that those kinds of things come up in this particular person's life. And I'm glad that I know this person like that, because I can help make the call on, I can't allow you to put everything that you've got in your retirement with us. I cannot, of good heart, do that, because I know you very well, and I know what life circumstances get thrown at you. And I think that whether you're doing a B or a C, you need to know your investors at that level. Now, when you're doing a $30 million deal, I think it's a little different. But I would hope that all of the people that are a part of your team raising capital from their friends and investors would still have those kinds of relationships with their investors too, because I think it's very important.
Mm-hmm, mm-hmm. That's great. And the other thing too, and you heard it here first because I just made it up. The 506C, it also hit me, is that a problem with a 506C is that the C is like a commodity. What you're offering, it becomes like a commodity because you're competing purely on numbers. Just like, are your returns beating the competitors? And because, like, if people are just looking at ads in newspapers or whatever they use now, I haven't been outside in decades apparently, right? But that's what I'm trying to say is if you're competing purely on numbers, then it's a different kind of business model. If you are working through relationships, then it's like, okay, well, I'm not going to go into some area because the demographics are fantastic, because I don't know anybody. I don't know if I'd be, in the dangerous part of town or the safe part of town, things like that. Like, does that does that match up with your view of?
Yeah, no, I'm
of the
hearing what you're
benefits of it?
saying, and like even my friends that are very successful at raising capital, even when they're in a 506c deal, they're still calling their friends. Those are the people that are investing with them. It just happens that all their friends are accredited, but it's still a deep relationship. And after having fun with some bigger investors and getting freaked out when wires aren't coming through, I understand. I understand the need for making sure there's a really strong relationship there. And maybe there's people that they cold call enough that they meet their marks, but the comfort of knowing that your friends aren't going to let you down, I mean, that's immense. And so I know that for us, for at least a long time, at least here in the beginning, we're going to be doing Bs just because I like having that kind of a relationship with our investors.
And the other one too about C's is that you also need your accredited status verified, which means that you have to go through your records, get all the paperwork, and you got to show it to somebody. Like you might look at a C and say, okay, you have to get verified. Oh, hey, look, there are people who are willing to do it for like $50 or $60 or something like that. This seems like a breeze. And then it's just like, okay, well, I've read some people saying that they had to get like appraisals done of some of their property as part of the validation process, but I haven't heard anybody say that in person that they had to do it. So I don't know if it's, asking the barber if you need a haircut sort of situation, borrowing from one bucket. So what's up, Jason?
Well, I think if you go to some third party that you don't know and doesn't know you, you have to supply them with a whole bunch of information. If you go to like your lawyer that you use or your CPA who knows you, they'll be able to write a letter verifying, and it won't. If you use that lawyer and CPA regularly, they shouldn't charge you anything for a little letter, especially if you already give them a form saying, "Hey, just sign this." So I mean, they'll go
But
through,
it's still
make sure.
it's still a time-consuming process. We missed out on an investment because we couldn't get that letter in time.
Yeah, and I tried one of those third-party ones online, and ultimately I had to upload the letter from the lawyer to them to get it. So I mean, it totally defeated the purpose. But
Yeah. Well, there you go. Good stuff.
What you also have to understand is that once you get to the point of having an investor get to this know, and then eventually the like, and then the trust, a really cool thing happens. If they go through this entire process and they actually invest with you and they start seeing returns, guess what happens? They eventually have so much trust that they bring in their friends and family to start to know you as well. And this whole cycle continues to go over and over and over. And that's when you have that exponential growth in your investor database. So hopefully you have a better understanding as to kind of how I think about our investors and how the whole entire process and path. And hopefully it'll help you as well as you continue to move down this path as well. So that's kind of the 4 steps, kind of where we're going to focus on today, Angela, is that maintaining investors. I think your mute button is on right now.
Dang it, I'm gonna have to remember to take that thing off, but I don't want you to hear all my papers rustling as I'm taking notes. And yeah, I was one of the people that thought that it was trust, but it makes sense.
Most people do.
Yeah, and like Cindy said, she's like, you have to know someone to trust them. So,
right.
But it's like that. What is that joke that goes around? The woman wakes up, opens her eyes, and goes to the door. Whatever. What's the first thing she opens? Go and open the door. What's the first thing she opens? And a lot of people say, oh, the door. No, it was her eyes. But it's that catching it and being like, oh well, if they don't ever meet you and know you, they can't trust you. Yep. So, do you feel like are you seeing that investors are like dropping off in investments because of what's going on with COVID? Or do you feel like more people are searching for something to put their money in? Or
Well, I'll kind of bring you back to earlier this year when it all happened, right? So we actually put together a deal and got a deal under contract. And then earlier this year in early March, and then a week later, the bottom falls out of the market. And it's actually the largest raise that we had ever done before. So it was just about a $50 million deal, and we were raising almost $20 million for that project. And the one prior to that was one that we had raised $14 million on, and we ended up raising that $14 million in just under 2 weeks. And so this one, since that last deal, we had another 600, 700 new investors come into our website from that last offering. So we were like, oh, this will be an easy one to raise for, even though it's a little bit more. But obviously nobody could have predicted the whole COVID-19 pandemic and issues that were happening there. And so we, of course, had, I wouldn't say a very challenging time. We had a challenging time raising the funds during COVID because obviously there's a lot of unknowns. There's a lot of questions, a lot of concerns about what was happening. And it was the most work I've actually ever put into a deal as far as the raising capital piece of it, and, except for our very first one. But that's a whole other different story. That was because it was our very first one. Nobody knew about us a lot. And so it was a little bit more challenging there. But this one took 59 days to raise the money. We closed on the 60th day. So I mean, it was that tight, and that close of being able to raise the funds on it. And we did multiple.
Am I the only one who's thinking, oh, Dan, honey, just wait 2 years and then you'll know about hard times raising capital? Because like 2022, it's ouch.
No, I think
like webinar.
Dan's never had a hard time. Now, he does talk about the first deal, which I think is really unique, because I know, like, I was talking to somebody yesterday that said, well, we have to, I want to, I had to find a sponsor for my deal. While that is ideal, you can do your first deal without a sponsor. Jason and I wound up being the lead sponsors on our own first deal, and we still got it done. We've gotten a second one done, and it's nice to have somebody with a lot of experience on the team. But when you are basically forced and tasked with taking care of a property full on when you've never done it before, talk about massive learning. Jason and I, for the last 12 months, or actually more than that, for the last 16 months, have been drinking through a fire hose, getting pummeled with information, because it was like I say this, for me, it was like I knew nothing. And there were things that blindsided me that I freaked out about and then I dealt with, but I freak out first, then I deal. Jason tends to just deal. But I don't. Jason, did you feel like you didn't know anything going in?
I wouldn't say I didn't know anything. I would say I had a foundation that I was able to learn upon. So I definitely learned a lot more than if I hadn't done it. But I wouldn't say I went in like totally blind and didn't know anything. So
yeah, but the first deal is always.
Would you put a percent on it?
Mm-hmm. Well, like I said, I knew
that makes sense. But yeah, Jason, would you?
3.
Like I said, we had enough for a foundation, and we just built upon it. So I mean that I don't know if I could put a percent on it. Just because we learned so much, especially learned a lot about like different loan products and stuff like that. And,
that
but.
makes sense.
No. But for anyone out there thinking the first deal is going to be super easy, it's not. It's hard for everybody, even people like Dan Hanford and Joe Fairless and Zach Happenstall. Like, the first deal is difficult. It just
they all have their first deal stories. Every single one of them, and most of them aren't good, but they didn't quit. They kept going. So.
Yeah, I love that. And that's something we've actually never discussed before. And like in my chance encounters and I need to put the link for our not a chance encounters up in here. I'll put that in the chat momentarily. But I always mention that the sponsor KP piece, unfortunately, a lot of coaching programs kind of gloss over it. And I personally am suspicious. The reason is because then people will know that you need to know more sponsors if you're going to be doing deals, or else you're kind of stuck with just the one that you know. But I mentioned in the chance encounters that you generally need to have somebody in the fold who already owns a similar asset. So for you guys, was it the residential background that made you eligible to be the lead sponsors, or how did that work?
It did help for the first one. We have 20 years experience with residential. Our partner also had experience with residential and multifamily. So between the two of us, we were able to get the job done. So,
and that's the thing, is it takes more than just net worth and liquidity. You also have to have some level of experience, and that's something I learned about. I don't want to take away too much from Dan's presentation here, but one of the things I learned about last year was that you don't have to have a Fannie Freddie card to get an agency loan. Now, the people that get them without that Fannie Freddie card is very, 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 very low. because the largest amount of default comes from that same group of people. So that's why they say you have to have a Fannie Freddie card or experience. But it's not that you have to, it just makes it way more likely that you're going to get that agency loan. But agency loans are not the only way to get a multifamily deal done. There are other options. And when you go through your first deal, you're going to learn about those other options, because for us, at least, getting an agency loan was very, very difficult. And so we went a different route.
Yeah, if agency doesn't like your market or something, they're going to look for any reason to not loan for it.
Mm-hmm.
Or if they do loan for it, it's going to be on super low LTV terms or higher interest rate or whatever. Definitely not appealing.
Yeah, no. And I would say that, like, as soon as they start making you jump through extra hoops, start looking for a different product, because nobody's going to tell you the bucket is empty, which, you know, when I say the bucket, I'm talking about where we are.
Sure.
For us, it was a small balance loan, very small market. That bucket was empty, but nobody said that to us. Instead, we just had to jump through more and more hoops. And so my suggestion and just advice to people out there is, when your lender is making you jump through more and more loops and more hoops, go with a different loan product, because there's easier ways to get it done.
Mm-hmm. Mm-hmm. Yeah, and that non-recourse part, it sounds amazing, but it really seems that, you know, like all loans are sort of recourse, even non-recourse, you know.
Or especially if you're not making your payments, which, if you're going to make all your payments and you're going to do everything that you're supposed to do, you're going to keep up with your business plan and your CapEx schedule, then you're going to be fine. Because the only time it becomes a problem is if you don't meet what your requirements are and you don't meet your obligations. That's when it becomes a problem. But even a non-recourse loan is going to become recourse if you're not doing what you're supposed to do and you can't meet your obligations. And that's where that saying of all debt is technically recourse, that's where it comes from.
There you go. You heard it here first. Awesome. Let's keep going with Dan Hanford. This is the REI Rocks review. We're here starting at 11 a.m. Eastern every Friday. Let's go.
And updates and like overshared information on what we were finding in due diligence and the collections and all of that, to be able to make sure that they understood that you know, why we were still going after this property, even though it was in the middle of COVID-19, because there were a lot of other deals that were falling out, and the deal that we were putting together was a perfect fit for the environment, which I think is what really kind of meshed really well, and a lot of the investors who understand it. So yes, there were a lot of investors that decided not to invest, but obviously we were able to get a lot of investors to invest. And there's kind of four main areas during COVID that we're seeing that people, especially early on, you know, some of this has kind of shifted and changed, you know, because, you know, of one of these things has not been as big of an issue, but one of the first things I would say that an investor will say is, you know, I lost a lot of money in the stock market because of the crash earlier in March, and I need to recover that before I can invest again. And so that was one of the reasons. And you can't convince that person to invest because they don't have the money to invest it right now, right? And then the second person is someone who wasn't in the stock market and wants to put the money back into it at the low point so they can write it up, right? And so that person was hard to convince. And then there was a person that actually wants to hold on to their capital between for right now, because they want to wait till these really good solid deals that they're going to hopefully see that they saw back in 08, which, you know, I'm of the belief that we're going to see some of that, but it's not going to be to the level of what we saw back in 08. You know, back in 08, you could get 20, 30, 40% discounts. And now I think you're going to probably see between 4 to 5, maybe 7% tops as far as discounts on some of these properties. And they're going to be properties that are in some of these secondary and tertiary markets. Not a lot, most of those are not going to be in those primary markets. And then the fourth thing that we were seeing is an investor that they didn't necessarily lose their job, but kind of the easy example is somebody who is like an orthopedic surgeon or a dentist, and they stopped all elective procedures. And so what most people don't realize about physicians is that when they work for a hospital, the hospital doesn't usually pay them unless they're actually working, meaning that they have to be doing procedures and surgeries and, you know, things like that in order to get paid. And so if they go off for a month or 2 months, which I think they were out for about 6 to 8 weeks, they're not getting paid. And so those investors basically said, hey, I can't invest right now because I have some money, but I don't know how long it's going to be before I have any more money. So I need to preserve some capital. But overall, the sentiment, especially lately, has been really positive. We've had a lot of investors. We've had 2 other offerings since that offering. One was a $27 million deal, and one's a $57.6 million deal. And, you know, we've been able to raise the funds for those ones just fine and haven't had any issues. And we're very rarely getting investors that are now saying that they're not investing because of COVID. They're just other, you know, things that they might not invest for because of, you know, things that we might have even heard pre-COVID.
Wow. Well, I know, like, for us personally, we held on to our cash a little bit because you don't know what's going to happen.
Yeah.
And there's so many things causing false reactions right now. Because like I think about like the stimulus packages and how is that truly going? What's the outcome of that going to be? Well, we don't know because it was a false movement. It wasn't like, it's not real cash. I mean, it is to people, but I mean, like, it wasn't a market reaction. It was a forced reaction. And so my concern, just as an economist, is how is this going to play out once the false reactions are gone? How are people going to adjust to the fact that there's so many more dollars in the money supply? because the value of the dollar is going to have to fall at some point. It's going to have to. And what's that going to do to prices? Are prices going to skyrocket? Are we going to see just a massive amount of inflation? I don't know. And so we just kind of held on a little bit, and it's. I mean, what do you think? It's going to be crazy, right?
Well, I mean, I think that just like whenever you underwrite a deal, even pre-COVID, you're underwriting to the current market conditions. So it's hard to be a speculative investor and try to predict what's going to happen in the future, which is one of the reasons why I don't like the stock market. Because whenever I look at the stock market, it's always, oh, I wish I would have put money in that stock, because I always look at things at the end of the day, right? Oh man, if I would have put money in there, I could have made X, right? But it doesn't usually always work that way, right? It's after the fact that we look at something and go, man, I wish I would have done that. And the thing that I tell investors right now that are kind of sitting on their capital is, right now you're sitting on your capital and it's making nothing, right? So you also now have this lost revenue and lost opportunity costs for the money just sitting there doing nothing. And for those investors that kind of are sitting on their money and they're expecting these deeply discounted deals, they're not counting that cost of just sitting on their capital for a year while they wait for those phenomenal deals. And so, and I think it also depends on, the level of capital that you have to deploy. Somebody who has 100,000 and that's all they have to deploy, like, I'd probably sit on it too, but somebody who has maybe 10 million, on the other end of it, I mean, they're placing capital right now, right? So I think it just depends. And they're placing smart capital, right? They're placing capital in areas where they feel are going to be good for the long haul. Because the investors that say, oh, I don't know what's going to happen over the next 6 months. I'm like, yeah, well, I don't know either, but I don't go into these types of investments for the next 6 months. Will there be an issue in the next 6 months? It's very possible that there will be, but that's short-term thinking, right? These deals are going to be great deals and going to be phenomenal assets into the future. You look, we're going to sell the property in 5 to 7 years. They're going to be performing really well. I mean, one of the things that COVID did is it kept people at their houses for a long period of time. And guess what that's going to do? It's going to create more demand for multifamily, because we're going to have more marriages, we're going to have more divorces, and we're going to also have more babies, right? COVID babies is what we're going to have. Mark my word, in January and February and March of next year, there's going to be an influx of the population just because of COVID shutting down, because of the entire world shutting down. And those are going to be those COVID babies, right? And that's just going to increase the demand for multifamily across the board. And we're already seeing that, especially in the Southeast here. We primarily acquire properties in the Carolinas, and we're also looking inside like Atlanta, Georgia, and Jacksonville, and things like that. We have a few assets in Texas, but for the most part, there's a lot of people that are flying in or moving down from New York and New Jersey and Boston, and even on the West Coast of California, going into these southern markets, these southeastern markets, because of the better economics, and also because trying to get away from the politics that they're seeing in the cities that they're in right now. And so you're seeing this great migration that's actually happening, where these people are moving in. And I'll give you a quick example.
And moving around is a very scary process, especially if you don't know people all over the place. And I think one of the very best ways to know a bunch of people is to join on Mondays at noon Eastern on Marvelous Mondays using this QR code or this link here. So who wants to say a few things about Marvelous Mondays? I'll hold my breath. Ready?
I was going to give Jason a chance. Dang it. Marvelous Mondays is truly a marvelous way to start your week. We love it. It's pretty laid back. And I think it's really just a solidification of the idea of it's really important to build friendships, because in that Marvelous Mondays, in that group of regulars, we've really got a family going. There's several of us in there that we really became friends at the beginning of the virtual landscape that came with COVID. So we've been really good friends, seeing each other multiple times a week, every week for, almost 3 years now, I guess. And it's truly amazing. Those are true friendships. And when you finally get to meet those people face to face, it's not like you're meeting them for the first time. It's like you've known them forever. And it's not weird to give hugs and be like, oh my God, wow, I've never seen you like 3D. And it's awesome. And so I'm really fortunate that we were able to offer this platform up as a virtual meetup. And it has been amazing for us. And I believe that it's been amazing for a lot of people that have joined that platform on Mondays for the Marvelous Mondays meetup.
I was going to say it's not related to the Marvelous Mondays, but Angel predicted our current predicament back in September of 2020. With
it turns out there was inflation.
Yeah.
Yeah. Well, but I think there's a better piece there too, because if you'll notice, this is the fall of 2020, and Dan was saying, Hanford was saying, there are people that are holding back. They're waiting for the bottom. They're waiting for that bubble to burst. They're looking for those 2008 prices again. Well, guess what, friends? We're 24 months later plus. It still hasn't happened. It still hadn't happened. And that's the other, I don't really like making, I can't even think predictions about what's going to happen in the future. but I'm leery of there being a huge drop or there being this bubble burst, because I just don't think I don't truly believe it's going to happen. I believe that inflation is going to stick around. I don't know for how long, but it's prices aren't going to go back down to what they were.
Yeah, I agree with that too. There's just no way. Rock and roll. Let's do this. This is the REI Rocks Review. We're here on Friday mornings at 11 a.m. Eastern, and this is the last one of 2022. Exciting stuff. Dan Hanford talking about capital raising for commercial deals, the climate, and all that kind of fun stuff. Here we go.
It's a single family residential example, but I have a staff member of mine that's actually moving out of her house, and she's moving somewhere else, but she put her house on the market, and within 48 hours, they had 37 tours of the property and had over 10 offers at above the asking price, all cash, no contingencies, right? So that's the demand right now that's happening in the Carolinas, is that there's just so many more people that are wanting to move into these areas that it's just creating a huge demand for multifamily. And, you know, when you talked about the potential of people not being able to pay their rent, it's very possible that that's going to happen. That's also one of the reasons why our group likes to buy a little bit higher quality assets. So we're buying B+ with value add and Class A assets, suburban Class A assets, which have affordable, you know, Class A rents. And we're not seeing a major drop at all in occupancy or collections or anything. We didn't see it the entire time, right? And I think it's because most of the residents that we have in our demographic profiles are going to be residents that are not just living paycheck to paycheck. They have a job that allows them to be able to put money away for times just like this. And those people also receive the stimulus. And guess what they did with the stimulus? They didn't spend it on rent. They didn't spend it on food. They kept their job. So guess what they did? They put it in their savings account. And there's a bunch of people right now that are sitting on those trillions of dollars of capital, and they're going to be deploying that capital over the next 6 to 9 to 12 months as well. I think we're going to see a large growth in the GDP over the next 12 months because of it.
Wow. So you bring up another point, and I think you've talked about it before in a different at a different time when you were speaking, but that you've got those A and B class tenants, and they will do whatever it takes to not become a C class tenant. I'm pretty sure it was you that told us about that, and that's something that's really pretty important, because I don't know what the stigma is, but they will.
I don't necessarily think it's a stigma at all. It's more of a, you know, people want to hang around people that they want to be around, right? And it's kind of hard to explain. It's definitely a psychological thing, because I don't want to go live in a neighborhood that I don't feel comfortable in, right? And same thing with these residents. They don't want to go live in a neighborhood that they don't feel comfortable in, right? And so they're going to want to do anything they can, whether it be getting a second job or a third job or whatever, if for some reason they need to do that. But they also, you know, you can also look at the demographic profile of a Class A and a Class B tenant and understand that they actually have a little bit higher concern for their credit rating than somebody who's on one of these lower end assets. And so where we are seeing right now some of these residents in the Class C assets just turning their keys in and skipping and just saying, hey, I'm out. They're not even fulfilling their obligations, or ones that are just staying in because of the eviction moratoriums and not paying. Guess what that's going to do to them? It's going to affect their credit score. And so that's one thing that they don't understand, or they don't see, or they don't care about. When you have a higher resident demographic, then those residents care a little bit more about their credit rating. They're going to do what it takes to be able to make those rent payments.
Yeah, that makes sense. And when I was teaching middle school, and it was a high poverty environment, it's a lot of times I don't think it's that they don't care about their credit. It's that the choice is between food or roof. So do we feed the kids, or do we keep a roof over our head, or do we put gas in the car, or pay for a doctor if we need a doctor? So it's
I think that's a very small minority of people that are in that demographic, but you're going to have that same demographic happening in every single one of the classes. So we're talking primarily in generalities, not on specific individual circumstances. So I would agree with you. There are circumstances like that, but if you make a general statement as a whole, you know, 80% of the people that are in these different profiles are going to fit within what I just said. And there are going to be some outliers, but there are going to be people, the majority of them, I'm not going to say they don't care about their credit. They just don't care about it as much as a different resident profile in a different property.
Yeah. Well, that makes absolute total sense too, especially when you think about like buying vehicles or making those bigger purchases where you're going to have to finance them, and you're going to want to be able to finance them at a lower interest rate. So that makes a lot of sense. I just hadn't really thought about it like from that perspective. So that's pretty awesome. So kind of going back, do you feel like there is a big importance on the relationship still when you're looking at investors? Or because I've been hearing a lot that there's lots of investors out there that don't care about the relationship, they care about the numbers. But I'm a relationship kind of person. I like talking, I like getting to know people. And I mean, I would think it's still important. How do you feel about that?
Well, I would say that you know, when you talk about investor relations, the most important piece of it is the relationship piece, right? That's why they call it investor relations. You don't call it just investor numbers, right? I mean, for a lot of investors, the numbers are how they make decisions, but they also have that relational component to it. Very few investors are just going to Google a website or see an advertisement and then just look at the numbers and invest, right? You know, they want to actually know that sponsorship team. They want to understand how they operate. They want to understand how they think. And there's a few things that we do in our group that allows our investors to actually know how we think. Like we actually show them how we think, and we do that by a couple of different areas. So, first, before we even get to that level, even, when an investor first reaches out to us, whether we're doing a Bravo or a Charlie, the first thing we're going to try to do is jump on a phone call with them. We want to jump on a phone call with them to kind of make introductions, to say hi to them, understand their background, their history, and also see where they are right now as far as their investing side of things. And it allows us to be able to make sure that they're a right fit for our group. And it also allows us to make that relational connection to them, because we want to make sure that they don't feel like just a number. So the first thing we're going to do is schedule that phone call with them, to jump on a call, spend 15, 20 minutes understanding who they are, what their investment goals are, and to see if we're a right fit. And one of the things that I do immediately after that phone call is I program them into my cell phone. And when I program them into my cell phone, there's actually a field called company, right? At least in my iPhone there is, and I'm sure in the Android devices they have that as well, where when you type in their first name, last name, there's a place there for the company name. And in the company name, I actually write in there the city and state of where they're located. And the reason why I do this is because when I'm traveling, I can actually just type into my phone a city of where I'm going, and it pulls up all the investors in that city. And I can personally reach out to them and text message them and say, hey, I'm going to be in the area, wanted to see if you wanted to meet up for a cup of coffee, or if I have a dinner schedule, I'll do a dinner with them. And it allows me to even deepen that connection with them. And one little tip I will say there with that little trick is, if it's a city that is within a larger city, so for example, if you're in Marietta, Georgia, in Atlanta, Georgia, I would put in there Marietta, Georgia, but then I'd put also the word Atlanta. Because most of the time if I'm traveling to Atlanta, I'm just going to type in Atlanta. I'm not going to remember all the different outlying cities within Atlanta. So I'll usually just put in Atlanta, and so I can pull up all the ones that are going to be in that particular region or that particular area. But that's been really helpful, because one of the other things we do is investor dinners. And so we schedule those investor dinners whenever I'm traveling and speaking, which this year has kind of been hampered a little bit because of COVID. But we reach out to our investors and invite them personally to these exclusive investor dinners. And our goal with those investor dinners are not to pitch them on anything or to sell them on anything. It's really just to build a relationship with them and connect them with other passive investors in the area. And so I'm there and to answer questions about our group and things like that. But I don't like get in front of the table and do a huge presentation, a big song and pony dance. That's not my goal. My goal is to really build a deeper relationship with our investors. And then one of the kind of final keys that I would say has been very pivotal and very instrumental in the growth of our investor relations piece is our physical newsletter that we print out and mail to our investors every single month. And I don't know if I have a copy of one of these around here, but this printed physical newsletter has allowed us to be able to stay in front of our investors. This is the whole piece about maintaining investor relationships, right? So we might go 3, 4, 5 months before another deal, but they're hearing from us every single month, and they're getting that in their mail every single month. And it's a really nice, well done, high gloss printed newsletter. And it's usually about 12 to 16 pages. And each one of the partners writes an article in that newsletter about something that they're working on. And I'll usually write on questions that I come across when I'm talking to investors. And so, I'll give you a quick example. I did one recently on what's the difference between preferred returns and preferred equity, and where capital stack structures and equity waterfalls. And because all of these are like terms that the investors are seeing, but a lot of them don't really understand them fully. And so we're able to go in there and educate them on this. And even just this month, I wrote an article on unreturned capital contributions, because they've heard of those before, but they read the PPMs and the documents, but they don't always fully understand them. So I want them to fully understand what those terms are and what things are. And that's what we do in those printed newsletters. And we send them out every single month. And yes, it's a lot of work, and we do all the design stuff in-house. So we have a good director of marketing and PR, and she handles and manages that entire piece of it. And she makes sure that we submit our articles, because we have to get those in. This is usually the time of the month that we have to get it in for the next month, because we have to have time to have them printed and mailed and be able to drop on the first, second, and third of every single month. But those physical newsletters actually help us in the securing capital phase. And the reason why is because in the securing capital phase, we actually print up the investor offering memorandums that we send to our investors, and we mail them to each one of our investors so they have a physical hard copy. And I actually have one of those sitting right here for one of our deals. This is actually one that we have right now called Braxton Carey Weston. It's a nice, high quality printed, offering memorandum that we put together for our investors, and we mail this out physically to each one of our investors, and so that they have a hard copy of it. Because there's a lot of investors that their emails go to spam. Well, guess what? This never goes to spam. This always gets delivered, and it's always delivered via priority mail, so they know it's important and they open it up. And this is also something that they like to share with their friends. Hey, look what I invested in, and hey, look what I'm doing right now. And they'll pass it on. They'll put it on their shelf. They'll put it on their coffee table, and it becomes a conversation piece for people that are in their network and their friends as well. And we've seen our referrals really exponentially increase because of that as well. So that's what I would say is probably one of the key things we've done, Angel, is really started to do some things that other groups are not doing, because most people just send out an email and hope for the best. And we've really tried to deepen that relationship by getting in front of them and also being able to send them something on a monthly basis. And I even get people. I had an email just this morning, Angel, where an investor reached out to me and he said, one of my friends is getting your newsletter and I want one too, right? And so he reached out to us directly and just said, hey, I want to get on your list. And that was because they had the printed physical newsletter and they talked about it with somebody else and they wanted to be on that list as well. And so that's kind of the main thing that we're doing that I think that a lot more people and a lot more groups should do. It does take a little bit more work, but it'll definitely pay off in dividends into the future.
Yeah, so earlier on, you said that for this last deal that you had to go through, you had like 600 or 700 investors come on, like new ones.
Mm-hmm. Yep.
That's a lot.
Yep.
How long did it take you to get that kind of a reputation, or to make people want to be in business with you?
It was not overnight. It was not overnight. I was actually just checking we use Active Campaign to manage our investor, relations piece of it. And we have a dashboard that allows me to kind of open it up and see how many in the last 30 days of new leads we've had. Just in the last 30 days, we've had 126 new investors come through our website. And in the beginning, it wasn't like that. Like in the very beginning, we were lucky to get one, right? Like maybe 2 or 3 a day, and then it would just kind of build up over time. But that's the other piece of it is being consistent with whatever you're doing. Because I see so many people that start a podcast or they start a blog or they start, an article or YouTube channel or whatever, Facebook group, and then all of a sudden they just stop. And you have to be able to create consistency in whatever you're doing. And that's what allows you to be able to maintain, be able to get the level of investors that you really need to have to be able to grow your syndication business.
Wow. I think that's really important. And the consistency part of it can be really hard. I know that like I had said at the last summit, I'm going to start doing webinars in, by the end of the month or something. And it was the last week of the month. And like I had gotten together with Sandhya and a couple of other people. I'm like, I've got to do something this week. I have to, or I'm never going to do it. And so it was like, I thought I had eked into the end of April. So that it was actually within the time span. I said it was actually May 1st. But we started the weekly episodes May 1st and we've stuck it out. We've managed to have them every week, but dang, it's hard. And if there's one thing that COVID really taught me, it was that even when you don't want to do it anymore and life is just pounding down on you, you committed to it. And you have to stay committed to your goals. You've got to stay committed if you ever want to get there. And so it's getting easier again. But for a while there, I was just like, oh, I've got to do another one.
Well, and it's good when you have a team that can help too, because I actually am starting to. I do my webinars as well every single week, and they do get to the point where it's it's a lot of work, to put those things on. But it's definitely been helpful from a consistency standpoint. But you have other people that can help you do them. Like I was out of town for a month in the summer because we went to my family on a vacation down to Florida, and I didn't do webinars while I was gone. So, but my team, Brandon and Danny, they actually, and even Melissa helped out and actually did some of those webinars while I was gone to maintain that consistency. And so if you have other people like that you can call on, that's even more beneficial to be able to do something like that. So you can kind of you don't always have to be the one leading those particular types of webinars.
Yeah, it's been a unique experience because I tried really hard not to get depressed and get down, but it was tough. All the kids were at home, they were loud, and there was 2 weeks in there where even my son was home, didn't have any ABA, which my son has profound autism, and it's tough. He has the autism nobody talks about. He's still in diapers. He's got like 150 words, but doesn't ask for help. It's just tough. And he's bigger now. He's 10, and when he wants something, he uses all of his body weight to make you go get it for him. And so there was a lot going on, and knowing that I had committed to doing those episodes and knowing that I had to fix my hair and put makeup on and put on a smile and be the me that everybody knows and not I probably could have let some of those feelings out and people would have been like, it's okay, Angel, you're doing great. But I didn't want to come across that way. And so I just committed to it and I was like, dang it, I'm going to do it. And we pushed through, but it can be really hard. And right now we don't have a big team that can help us. So we don't even get any time off. So yeah, it can be.
It's okay to eventually every once in a while not do one. There was times earlier on that I would skip weeks, but I didn't stop there, right? I just picked them back up after I was able to, go away for a week or two or whatever, and then pick them back up. It's just, you don't want to just all of a sudden stop, just never start back up again.
Yeah. Well, and my fear would always be if I stopped, I wouldn't keep going.
Yeah.
I would just stop. And that's a weird one. Cause like, we did 75 hard, which is crazy hard for anybody that's thinking about doing it. It is tough. The requirements, each requirement is simple, but it's that combination of them that it took me 95 days to get through 75 days, 75 hard. So it can be a real difference. But we actually did it for 102 or 103 days because Jason was like, let's just do it for 100. We're already at 95. We're so close. And I was like, really? Because it's no alcohol. And I like my bourbon. And so we went ahead and we made it for 103. And Jason's like, well, it's a habit now. And I look back and there's already things I don't do. I did it for 103 days, like a gallon of water every day, reading 10 pages every day. And there's already, if I don't read, I don't read. And I don't worry about it. If I don't drink a gallon of water, oh well. And I saw the difference it made. And so the idea that it takes 56 days or 28 days or whatever to make a habit, no, it's very, very easy to lose the habits and to lose the consistency. And like the idea that you mail things out to stay in front of people, that's really big too. So yeah, I don't know. I'm like, kudos to you. That's so awesome that you can stick it out and make those things happen because it's hard. It's really hard. And I've seen people who have done their podcasts and then they do them for like even 6 months and then just stop and you never hear why or if something's wrong and they just stop. And I think it goes back to like what Andy Frisella said, and that's, do you have the grit it takes to stick it out with the grind? Are you going to be there? Where are you going to be in 6 months? Because even if there's 10 people and y'all are all the same and you're all out there getting it and you have the same belief system, give it another 6 months, 8 people are going to be gone. Yeah. Give it another 6 months, there's just going to be one.
Well, I had somebody just reach out to me last week. I won't say he's a well-known syndicator, but he was, kind of making his way into the syndication space and had already, co-GP'd on several other projects with lots of other groups. And he just called me up one day and he's like, I'm out, I'm done. I've lost my interest. I'm moving on. And he's like completely like out. And I was like, wow, okay. That also is like, to me, is like, you have to make sure that when you're as a passive investor and you're choosing the right person to invest with, make sure that they actually are truly, fully 100% on board, right? And one of the easiest ways to do that is make sure that they put their money and skin in the game on every deal they're actually going forward with.
Yeah. Yeah. Wow.
I know. That's what I said. I was like, okay.
That's because you put so much time building and becoming better known. And
He had a whole authority platform and a podcast and everything put together, and it's gone.
wow. But at the same time, I mean, kudos to him, because you're not supposed to consider those sunk costs when you make decisions. But wow. That's
No, I don't fault him for making the decision. I just
Unwrap that a bit because I love that saying. Okay, like about I've always called it don't throw good money after bad. You know, which is like if you've already sunk a bunch of money into it, because I've done that in several different businesses that I've been involved in, where it's just, well, I also call it the Forrest Gump one. You know, it's like, well, I ran this far, so I might as well keep going, right? That kind of thing. So, do you have any more thoughts on that, or is that?
So actually, I'm proud of myself right now because I know that what happened was on May 1st, I missed it by one day of starting up the webinars. Well, those webinars became the podcasts, and the podcasts, I think we just released 216 or 217. So the 217th episode. And so it's kind of cool to look at that, and then hearing myself talk about commitment and hearing Dan talk about consistency and seeing how much that affected me and played out into like the Marvelous Mondays that have been going every Monday we meet, whether it's a holiday or not. Now next year, Christmas falls on Monday, so it's going to be a little bit different, but we'll still meet because we meet every Monday, dang it. But it's really cool to see that even when things have gotten tough and I haven't wanted to keep doing it, or Jason hasn't wanted to keep doing it, we still show up and do it. And I think that's one of those things that plays into, bet on the jockey, not on the deal. And I think it's why more people are coming to us and being a part of our tribe, a part of our family, is that commitment and consistency piece.
Yep. What's going through my head as I'm watching this is I want to tell the angel in the little video here. It's like, oh, just wait till you see the portfolio changes in the next 2 years. You'll be very satisfied. It's good stuff. All right, let's keep going. This is the REI Rocks review.
Look at it and go, and that's a learning experience and learning tool that other people need to have when it comes to choosing partners wisely, is making sure that you choose partners that you know are going to be there for the long haul. I talk to investors all the time, like, listen, I'm not here to put you in one project and then go away. My goal is to continue to build your wealth along with my wealth over many, many decades, and we can actually grow together. You can start to bring on your friends and your family. We can just grow as a unit and as a team, and that's how we're going to be able to fight these REITs and these hedge funds and these family offices and these institutional players that are normally acquiring these large properties that we're acquiring. Is to stay together and to band together and actually push forward and be able to take down projects that people in our situation normally are not taking down.
Yeah, and that's so funny. Not necessarily funny, but it's kind of cool that you bring it up, because Sandhya is actually fixing to be on, and she's talking about vetting your team, like vetting the sponsors and making sure that it's not somebody that's an overnight operation, I guess. Although it'd be really hard to be overnight with syndication, but you know what I'm talking about. Here today, gone tomorrow kind of thing.
Yeah.
And making sure that you have that relationship and there's communication. And so that's it's a key piece. And I would have never even thought that would need to be considered, just because, I mean, my husband's ready to go active side on multifamily, and I'm just like, we put a lot of time into this, and to just say goodbye, but it doesn't make sense to me.
Yep. I know. It's very hard. That's why when they told me, I was like shocked, taken aback. I'm like, okay, what am I going to say?
Yeah. Wow. Yeah. Well, wow. So I just want to thank you for coming on and for being a speaker here today. And I don't know if I ever really got to thank you for helping me with that very first summit and giving me the push I needed and the words I needed and the ideas I needed to make it happen, because I certainly wouldn't have this one if it hadn't been for the first one. So
glad to help out anytime. I appreciate it, Angel. You're doing a great job.
Well, thank you. I hope you have a great day with your family. I'm assuming that you're probably at home with them, since so many people still are. But hopefully you've got a big enough place to get away every now and then.
Yes, thankfully we do.
Our house isn't quite that luxurious. We're a little bit on the small side. But yeah, thankfully we are a little bit more open here. So as far as like our location, like with us being in Texas, so we've been able to get out a little bit more here and there and go places. But anyway, I'll get off of that. So
I really do appreciate you having me on, Angel. I look forward to continue to follow you as you continue to grow.
Well, awesome. It's nice to know that I'll have another follower.
Yeah.
Awesome. Well, just thank you again, and hopefully we'll be catching up later.
Sounds good.
Awesome. Well, you have a great day, and I'm gonna go ahead and look for our next speaker. Before we get there, I just wanted to bring up again. Hi, Sandhya. Let me.
Sandhya. Yeah, I gotta say, I was so impressed. I've been giving our automated transcription service a little bit of a hard time, in the recent past, but it spelled Sandhya's name properly. Like when you were pronouncing it too. So like I'm really impressed. I think that's really amazing.
Well, and
And
I flip flop. I go Sandia, Sandia. It's like so it caught it right every time.
Right. Yeah, that's pretty awesome stuff. But that was an amazing presentation there from Dan Hanford. And one thing we neglected to do when it was quarter 2 was to mention Jason's underwriting services. And so that is why I put some triangles over my face and all that kind of stuff. So here's a QR code you can scan, or you can go to this link before we get to our doggy bag. Do you want to say some things about the underwriting services?
Yeah, I can help with existing underwriting. I can do underwriting from scratch. I've developed my own model, and I improve it pretty much every deal I do gets improved somehow. Click the link or go to the link and hit me up. I can be found on LinkedIn as well.
Excellent.
So
And
modest. He can do the whole
I'm
thing for you. Like he can totally help you out.
Yeah, a lot of modesty for sure. That's what I describe it as well. So, but let's move on to the doggy bag. Who wants to start it off? What are the takeaways from this, including what's happened over the past 2 years, what's changed and what's not?
I think very little has changed from the things that he's suggesting as far as how to keep your investors warm. That newsletter is just amazing. And he offers a couple of other things in the newsletter too. They actually do some pages of coloring sheets that are simplified versions of some of their properties so that the kids and the family can color the sheets too. So it really brings the whole family together in those newsletters. So I think that's pretty neat and something that I know that we are aspiring to do. We're not there yet. It's a lengthy process to be able to automate those kinds of the kinds of information that go into those. So we are hoping to get there soon. But yeah, we're gonna hope to get there because I think those are things that make you look. They set you out and they make you look like you're really on top of your stuff.
Mm-hmm.
Yeah, my doggy bag is actually something personal to some takeaways that I need to do or we need to do as a team to improve our investor relations as well. So
It's beautiful. Yeah. So for myself, watching that, it just showed once again that there are always excuses not to invest. I think that like I stayed out of real estate for a really, really long time, especially because I lived in Taiwan. But it never seems to be a good time. But you're not going to get the time value of money unless your capital is deployed. So I think that's really, really important. But this is another fantastic session. I'm always excited to do this. It looks like we're able to finish nice and early today at quarter after. But it's a new year. Do you want to say a few things about next year, or do you want to give everybody their time back?
Well, I mean, I would just, for those of you out there that have been looking for a mastermind to grow in, one of our big goals for next year is to really grow as a mastermind family. We have a mastermind starting in a couple of weeks, and that's something that we're really looking forward to. Now, I'm not a big proponent of set your goals for 1/1. That's not me at all. But knowing that that's something that we're starting and we're going to start it in the new year, I'm super excited to see what that does for our own personal growth as we move through that mastermind process over the next 12 months.
I love that. And some people don't have any exposure to masterminds. They don't know what it's all about. just say a couple things about what masterminds are in general. It's a group of entrepreneurs that commit to meeting fairly frequently. But the biggest thing is it's you're supporting each other, but also taking the time to understand each other's businesses so that there's nothing left to hide. And what I really mean is, like, we all want to look good to our friends and our families and all that sort of thing. But there are going to be some things in our businesses. It's the 500-pound gorilla. It's the boogeyman. It's the scary thing in the closet or whatever. And the only way we're going to be able to really achieve our dreams is with the support of others who are actually willing to understand what's going on and not just give you, I guess I should describe it as impulsive advice rather than experienced and knowledgeable advice. So I think it's a really great opportunity for different syndicators, and just reach out. LinkedIn is definitely the best way to pull that off. Angel has already put the link up on the chat in LinkedIn. We're also on YouTube and Facebook and all that kind of stuff. So make sure you subscribe so that YouTube starts paying for this stuff. And that's one of the biggest parts of our sustainability. We know that we're in for the long haul. This is, they mentioned the people dropping off the scene. And there's only one way to make this work, which is to find things that you can do for very long periods of time, keep that consistency, display it, and then let people know, hey, this is what I'm willing to do for you. So this is fantastic. I can't believe 2022 is over.
Right.
That's where I'm at. It's pretty something. All right then. So thank you very much for watching. Again, we're here every Friday. Make sure you connect with us on LinkedIn and have a delightful. Don't drink and drive. Find a place. I don't know what other generic advice I'm supposed to give, but thanks for watching. We'll see you again next time.
Bye, guys.
See ya.
Awesome.